This presentation is concerned with accounting for merchants, the middlemen who purchase goods from suppliers, mark them up, and sell them to other merchants or to the final consumer of the goods. The merchant must be able to make enough from the sale of the goods to cover all the other costs of operating the business and leave a profit that's sufficiently large to justify the continuation of the business. The difference between the selling price of the goods and the cost of the goods is referred to as the gross profit from the sale. If enough gross profit is received from the sale of the goods to cover the operating expenses of the business and still leave a profit, then our merchant is successful. In order to account for a merchant's operations, we'll need to be able to record the purchase of the inventory items and then their final sale. If we're going to be accounting for inventory and inventory purchases, then we need to know what inventory is. Inventory is a current asset that's purchased exclusively for the purpose of resale. Now, there may be many other assets in the business that are sold at some point, such as equipment or supplies that are no longer needed, but these assets were used in other ways in the business before they were sold. They could not be classified as inventory assets. Well, we now understand that inventory is a current asset that is held exclusively for resale. But we have two big questions that we want to answer concerning inventory. What costs can be included as part of the cost of the inventory account balance? And when is it that inventory should be recorded? The answer to the first question is inventory should be debited and cash or accounts payable should be credited for any costs incurred to obtain the inventory and to ready it for sale. Costs that can be included in the inventory account are referred to as inventoriable costs. In the example here, we have $5,235 of inventoriable costs to record. Here's an example that will help clarify these points. Let's say that Tom's Sport Shop purchases baseball caps to be held in inventory. The total cost incurred is $8,515. Which of all these costs can be included as part of the cost of the inventory? That is, which of these costs are inventoriable? All the costs highlighted in yellow represent costs that were necessary in order to obtain the inventory items and to get them ready for sale. Invoice cost and shipping costs obviously had to be paid in order to acquire the inventory. The shipping insurance was also necessary. Once the goods arrived, workers were paid to unbox them and ready them for sale, so this is again part of the cost of the inventory. After this, though, the advertising cost, the wages paid to the sales clerks, and the fire insurance on the store were costs that were incurred not to ready the goods for sale, but to operate the business and help make the sales. These are operating expenses of the period. They're referred to as period costs or period expenses. They cannot be included in the cost of the inventory. There are certainly a lot of rules regarding the costing of inventory, and you may wonder why this whole process is so complicated. The reason is, when a cost associated with inventory is incurred, we have two choices regarding what we do with it. It could be recorded as part of the cost of the inventory, or if not that, it will be recorded as an operating expense of the period. Recording it in inventory means we can keep the cost off the income statement. Now, eventually it will wind up on the income statement as part of cost of goods sold, but only when the inventory item is sold. Since the decision about whether a cost is inventoriable or not can have a big impact on the income statement and the balance sheet, many accounting rules are related to it. Let's answer the second question that we raised earlier. When is it that inventory should be recorded on the books of the buyer? When is it that inventory sales should be recorded on the books of the seller? The answer is when legal title to the inventory asset passes from the buyer to the seller. Then the buyer should record the purchase and the seller should record the sale. But in order to determine when this occurs, we need to understand the terms of sale. When a sale is made on account, the terms of sale will be stated on the invoice. Terms N30 mean that the buyer and the seller have agreed that the full amount of the invoice price net of any returns and allowances, is due 30 days from the date of the invoice. Terms 2/10 net 30 mean that the buyer can take a 2% discount off the invoice price if payment is made within 10 days of the invoice date. Otherwise, the full amount, net of returns and allowances, is due 30 days from the date of the invoice. Terms might also be anything else that the buyer and seller agree to. FOB refers to freight charges, and it stands for either free on board or freight on board. FOB destination means that freight is paid by the seller to the buyer's destination. FOB shipping point means that freight is not paid by the seller. The goods are loaded, but then the buyer is responsible for paying the freight charges to destination. Until you get used to them, the shipping terms can be a little confusing. For example, if a merchant makes a purchase, terms FOB shipping point, then the merchant is responsible for paying the freight from the manufacturer's place of business to the destination. But if the merchant makes a sale of items to a customer, terms FOB shipping point, it's the customer who's responsible for paying the freight. I'd recommend that you think of this diagram. And in the case of a purchase, if the terms are FOB shipping point, ask yourself, from which point will the goods be shipped? In this case, the answer is the manufacturer's place of business. Therefore, FOB shipping point means the manufacturer will load the goods, but the merchant will have to pay the freight charges to destination. In the case of a sale, FOB shipping point means the merchant is the point from which the goods will be shipped. The destination is the customer's place of business, and FOB shipping point means that the customer will have to pay the freight to the customer's destination. If the terms are FOB destination, then we can easily tell by referring to our diagram that the destination will be the merchant's place of business, and therefore the manufacturer will have to pay the freight, or in the case of a sale, with terms FOB destination, the customer is the destination, and the merchant will have to pay the freight. Well, now that we understand the shipping terms, we can return to our original question. When is it that a buyer should record a purchase, and when is it that a seller should record the sale of merchandise inventory? And the answer is when legal title passes from the seller to the buyer. This is at the point of sale, when the buyer takes custody of the asset from the seller. It's the terms of sale that will determine when this happens. Let's consider an example. Let's say that on January 1st, Tom's Sport Shop orders 20 baseball caps from Team Gear. The terms of sale are FOB destination. On the same day, January 1st, Team Gear processes the order and ships the goods to Tom's. The truck arrives at Tom's on January 3rd, and the baseball caps are delivered. When is it that Team Gear should record the sale of the baseball caps, and when is it that Tom should record the purchase? Since the terms of sale were FOB destination, then legal title will pass from the buyer to the seller when the goods arrive at destination. Team Gear is responsible for paying the freight and is responsible for the goods up until the point that they arrive at Tom's Sports Shop. Therefore, on January 3rd, legal title passes from Team Gear to Tom, and on January 3rd, Tom should record the purchase and Team Gear should record the sale. What if the terms of sale here were FOB shipping point instead of FOB destination? Then, legal title passes to Tom when the goods are shipped. That means on January 1st, Tom should record the purchase and Team Gear should record the sale. In this case, Tom took possession of the goods and legal title passed to Tom as soon as the goods were shipped. Now that we understand which party is responsible for paying the freight and when it is that legal title passes to the buyer, we should look at the issue of recording freight costs. When the merchant makes a purchase of inventory items, terms FOB shipping point, then the merchant will have to pay the freight. We understand that shipping costs represent a necessary cost of obtaining the inventory, and therefore are an inventoriable cost. So when shipping costs are paid, the merchant will credit the cash account and then debit the inventory account. You'll need to be careful with freight costs, though, since freight paid to ship goods to a customer would not be an inventoriable cost. If our merchant makes a sale to a customer, terms FOB destination, then the merchant will have to ship the goods to the customer and pay the freight costs. But this is a cost incurred in order to make the sale, not a cost incurred to obtain the inventory. Freight charges on goods shipped to customers will be debited to an account called transportation out, freight out, or delivery expense. Since this is an expense of the period that was incurred in order to make the sale to the customer, it'll be reported on the income statement as a selling expense. This ends part 1 of our video, and I hope it's been helpful to you.